Hello, Ben Anders here from Innovative Solutions CPAs and Advisors. Welcome back to another exciting installment of our series of short videos on the Tax Cuts and Jobs Act. You've probably heard about the new 21% flat tax for C corporations, which does a lot to help big businesses. But the Tax Cuts and Jobs Act also throws a bone to small business owners in the form of, and excuse me while I look at the name because it's really big, the deduction for qualified business income of pass-through entities. Also, probably in the future will be known as the Section 199A deduction. This is a 20% deduction off of qualified business income that you may be able to take before calculating your tax on your personal income tax return. First of all, let's talk about the definition of a pass-through entity as defined by the Tax Cuts and Jobs Act. Essentially, this is a business entity whose profits end up being taxed on your individual tax return. Common examples are S corporations, LLCs, partnerships, trusts, estates, even sole proprietorships qualify, and even rental properties qualify under the rules of the Tax Cuts and Jobs Act. Here's how this provision works in a nutshell. First, you calculate the pass-through profit from the entity. Second, you take a deduction equal to 20% of that profit before calculating the tax on your individual tax return. Sounds pretty good. But don't get too excited yet, because your deduction may be limited by several factors. First of all, for all taxpayers receiving this pass-through income deduction, the deduction may be limited based on your income. If you're a very high income earner, the deduction may be either reduced or eliminated completely, but not necessarily, because there are always exceptions to every rule. Second, there's a reduction of the deduction if you are a high income earner and the pass-through income is coming from a service-based business. This will be a real bummer for high-income earning doctors, nurses, accountants, lawyers, financial planners, athletes, etc. Of course, there are exceptions to every rule, especially when dealing with the IRS, and for some reason, under this law, architects and engineers are exempted from this reduction. Even though architects and engineers are both technically service-based businesses, they will not be subject to the phase out of the deduction at high incomes. Go figure. There also may be a silver lining for high income earners who have service-based businesses and also have, say, a rental property or an interest in another business, because just because the phase out reduces the deduction they can take on their service-based income, it does not necessarily reduce the deduction on, say, their profit from rental properties. I urge you to consult your tax advisor about it right away, especially if you are a high income earner with interests in several pass-through entities. Because with proper planning, you may be able to restructure your situation to avoid some of the phase-outs and take advantage of the full 20% deduction. As a matter of fact, we recently helped one of our business customers restructure from a C corporation to an S corporation in order to take advantage of the changing tax law. I'm excited to say that there are two owners in this business, and now they will each be saving approximately $25,000 a year on their taxes. So that is really good. And yes, they are high income earners, but it's not a service-based business, but because of the exceptions to the rules for some high income earners, they were able to qualify. So consult your tax advisor, do some proactive planning, and hopefully you can qualify for the complete 20% deduction as they are going to be able to do. That's about all I have to say today. Hope you have a great day, and thank you very much for watching.